And welcome everyone to this webinar. We're going to be talking about the Build Back Better Act. That is the $3.5 trillion budget reconciliation measure, full of sort of soft infrastructure and social spending. It includes innumerable tax changes, many of them raising taxes, and it also includes a number of provisions relating to retirement savings plans. The bill is 2,468 pages. I have not read every page, but I'm confident that my fellow panelists have done so. I might add that the key provisions that we believe will most affect advisors and your clients are summarized in the Mindset memorandum that was circulated to you all earlier. Who is Mindset? Well, Mindset are the other folks on this panel. They are a bipartisan public policy firm that IA has had the pleasure of working with since the first of this year. I think we're off to a good start for a long-term relationship. Okay, before introducing the panel, a couple housekeeping measures. One, this is not for press, so no press. Two, this is off the record. And three, as Megan mentioned, should you have questions, please submit them through the chat feature, and time permitting, I will raise them and address them to the proper expert on this panel. Okay, who's on the panel? We have Langston Emerson, King Mueller, and Bridget Hagan, who are all partners at Mindset. We have Chris Brown, who is a principal, and Doug Lee, who is senior director. I am not going to read their bios. I assure you, they're all very impressive. There is experience in the House, in the Senate, at the Treasury Department, at the White House. I think the only thing they're missing so far is a former member of the Supreme Court. Okay, and I might add, although they all speak Capitol Hillese as their native tongue, and we're going to be talking about tax, I have implored them to speak plain English, and that's in particular you, King Mueller. Okay, before we get into some specific provisions, let me send a first and preliminary question to Langston and King. Where does the bill stand? And since reportedly it's being pared down from 3.5 trillion to perhaps 2 trillion or less, is there still reason to be concerned about all the tax provisions and tax increases?
I'll start, Neil, and thank you for having us. I think we're all happy to be here and provide some context and insight. Although I would start out by a few bottom line items as it relates to reconciliation, and it kind of goes to what you alluded to, Neil, is that there's still a lot in flux, and what will likely be in or out at the end of the day when it gets to the president's desk is still pretty clear as mud. So that's the first point. The second point is this exercise is something that we all expect to go well into the holiday season. We're looking at maybe mid-December before something is actually done with the reconciliation package. So there's a long way before we see some finalizing of what is actually the bill that makes it to the president's desk. And the last point, so what we're hoping to do today, and Neil, I hope we make you happy here, is that we want to provide some prognosis or provide some color behind our prognosis about what we think is likely to stay in or not, at what number and why. And so I wanted to level set there because there's still a lot that is just not clear at this point, but we do have some pretty good insight and intel that we want to share. So yeah, you're right to start, and I will call King in to be really helpful. He leads our tax practice and is the former Treasury member of the firm that you mentioned. So I definitely want to bring him in. I think you're right, though, as a threshold matter, the number of 3.5 trillion is likely, very likely, almost definitively will likely be smaller. The question is, what will it be? Our firm is taking a stance that it will likely be sub 2 trillion or around that point. And what does that mean for the different proposals that we will likely go into today. I mean, there are ways that we could look at, you can just delete some of or eliminate some of the potential provisions, or you can cut down, I guess, the amount of time if that would be scored at. So over 10 years, it could be shorter timeline, and they would, 5 years or so, which would ultimately shrink the number. So the question that the Democrats on both the House and the Senate side have to determine, and King, this is where I will stop and turn it over to you for some more detail, but is whether focus on a high level number, top line number, confirm that number, and also confirm what is going to be in versus out and how long those provisions will stay in law before they expire. Right now, things are scored over a 10-year period, which produces a certain number. Ultimately, if they pare it back in order to keep it in, then the number is much smaller. So I'll stop there. And King, I'll turn it over to you and probably chime in a little more before turning it over to Neil.
And let me just butt in, King or Langston, if you could explain what all this scoring stuff is about, please.
Yeah, why don't I go there? Thanks, Neil, and thanks, Langston. So you've probably been reading and saw last month. So we do have a draft that's out there. The House of Representatives, the Tax Writing Committee, the Ways and Means Committee marked up a bill, and it had roughly on the individual side about $1 trillion of tax increases and about $1 trillion of tax increases on the corporate/international side. I might back out the lens as I say that and remind folks that a lot of what's driving these tax policy changes are really all about financing the spending on the other side that the majority party here in Washington wants to enact. So there are some exceptions, but different than in previous tax reform exercises where you're really trying to go after certain policies. A lot of these proposed changes are, in the words of some Democrats that I talked on the Hill, the least worst alternatives to raise the amount of money to finance their spending. And I should also mention that at the end of the day, we still don't know, and I don't think the leaders in Congress know 100% how much of the total package, whatever size it may be, do they want to completely offset? Now that's budget jargon, but just think of it, if they spend $2 trillion, do they absolutely need to have $2 trillion of tax increases, or can they assume some dynamic growth through all this spending on the $2 trillion side, and therefore they don't need that much? You've heard a lot and read in the papers about certain IRS funding increases and reforms that might generate additional revenue. We call those soft pay-fors. So all of those factors will ultimately decide how much of the hard pay-fors, the things that I think we're going to talk about on this call, are really necessary at the end of the day. Couple of other observations. Usually in legislative process, the House of Representatives marks up legislation, the tax writing body, and then the Senate marks up legislation in their tax writing committee called the Senate Finance Committee. In this instance, because the majority party is utilizing a special budget procedure known as reconciliation, just like Republicans did in 2017 when they passed their Trump era TCJA tax reform bill, because of the 50-50 margin in the United States Senate right now, they will not be going through regular order to mark up legislation. That'll be important as we go through this conversation, because typically we'll have a sort of House point of view product and a Senate product. In this instance, we're really only going to have the Senate product. We might see proposals, but they're not going to go through out of the Senate, but they're not going to go through regular order. And one last observation, talking to some Senate folks in recent days on the tax writing side, they remind me that we are getting closer to the end than the beginning of this process. We don't know if it's going to go all the way to the end of the calendar year. It could technically bleed over into next year. I don't know. It seems like it's going to take longer than we think. 3 months ago, if you would have asked me, I would have said, oh, by Halloween, that's their backstop date. And that backstop keeps pushing back further and further. So I think it's a safe bet to assume that a lot of this uncertainty in the tax code is going to remain uncertain deep into Q4 for your planning purposes. And it's not a great answer, but that's just a reality. And the same goes with some very important effective dates of some of these things that we'll get to in a little bit. It's just the nature of the beast right now, that a lot of uncertainty with some of these tax policy outcomes. So why don't I pause there, Neil, and go back to you.
Well, thank you, King. So let's now jump into some of the provisions that are going to have a direct effect on advisors and their clients. And why don't we start off with some of the IRA and auto enrollment provisions specifically, and Bridget, correct me if I'm wrong, but there seem to be a number of provisions that restrict or otherwise limit the investment products that advisors can look at when managing IRAs. Why don't you tell us a little bit about what's going on in your read?
Yeah, I will. Thank you, Neil. And I'll take the speaker's prerogative to pull you in and ask you a question too, actually. So I think that's well framed. I think in the broad context of trying to raise money to pay for other priorities and trying to also get some long-standing priorities done, there are several provisions in this bill that would do exactly what you just suggested. I might want to contextualize that by highlighting really four things, I think, starting with broad sort of background on the retirement piece of this bill in particular. And when I say that, I'm referring to the House version of this big bill. So just for context, you all know this, having been in this field for many years, that uniquely, I think in some ways, retirement legislation has traditionally been pretty bipartisan. The Congress has been able to do some really big things working together, which in these days is not so common. That has really taken expression in the work of two people in particular in the House, Chairman Richie Neal of Massachusetts, who is the chairman of the relevant committee of jurisdiction, and the highest ranking Republican, Kevin Brady of Texas. And so they have worked together on bipartisan legislation that you all have been very active in supporting. And then somewhere along the way, there was—
And if I may, you're referring to the Secure Act, correct?
Right, exactly. And they've got a new, as you know very well, Neil, they have a Secure 2.0 bill that they were working on very well together. And then there was a little bit of a fork in the road when it became clear that Democrats were going to use this partisan, in this case, budget reconciliation measure to get a lot of their priorities done. So I raise that because I think it's important to contextualize the retirement provisions as Chairman Neal's personal priorities in the context of a bigger partisan bill, not necessarily the broad priorities of Congress, or frankly, even the broad priorities of the Democratic caucus. And so as we go through and talk about prognosis, I think that context is important. The first thing that you mentioned, Neil, that's very relevant to you all and in your daily business, is that the auto enrollment provision in the House bill comes from a long history of concern in the Democratic Party and beyond about the coverage of American workers. That's sort of the term of art, that what percentage of American workers have access to workplace savings. That's the reason behind it. The issue is, of course, as always, sort of in the mechanics of how it works in this bill. So the mandates as a general matter, and the bill would mandate that employers above a certain size automatically enroll their employees in one of these plans. Mandates are just not a bipartisan effort in general. And there are a couple things I wanted to flag, one of which I wanted to ask you to chime in on. But in the context of mandating that employers offer qualified retirement plans, the drafting of the legislation, I think, hit a snag because it wouldn't accommodate auto IRAs or auto simple IRAs, even though they intended to do that. The reason is because the bill doesn't amend securities laws effectively to change the know your customer rules and Reg BI and all the other rules that you all are very familiar with that you have to go through before you can get an individual enrolled in an account rather than through an employer. So that's actually a pretty big technical drafting problem that could have a very material effect on how this works on the ground that they have not sorted out. So that's one big problem. There's another issue that you alluded to that I'd love for you to chime in on, which is the default investments that are required. So I'll maybe pause there and let you speak to that, Neil, and then I'm happy to talk about other things as well.
Yeah, I just being mindful of the time, I'll just quickly say that there are, if an enrollee through the auto enrollment provision does not opt for the default options, the options are limited, and it can be a class of assets that is designed to protect the principal on an ongoing basis. I'm reading, forgive me. A balanced fund, or any other class of assets or funds determined by the Treasury Secretary to be a qualified investment. No other options are available. And I can tell you from the advisor's perspective, giving Treasury a regulator the power to determine what products are appropriate and what might not makes my skin crawl a little bit. So in fact, we did write a letter on that particular issue. There are other, of course, restrictions, and perhaps you can just talk about sort of private equity and some of the things that are really could be impacted by this bill.
Yes, that's a great segue. The other big, I think, problem, I guess, is a way to frame it in the retirement bucket of the bill is the so-called accredited investor provision that really restricts IRAs from offering investments that would be accredited investments outside of the context of an IRA, and it requires IRAs to divest of these investments within 2 years or lose their IRA status. This is really about going after private equity. They have that, Congress has that explicitly in mind. And so given that, and the fact that it raises for the government, it raises $1.7 billion over 10 years. And we're in an environment where they're looking under couch cushions to try to find money to pay for the rest of this bill. I think there's a really material possibility that if this bill gets done broadly, that this provision is in there. And unfortunately, and to some degree, because private equity is just not a sympathetic audience. And I know you all can speak to this better than I can, but many IRAs are invested in my mind, appropriately, in illiquid investments that are going to be hard to divest of in a 2-year period that is allowed under this bill. So I'll just zoom out quickly and end and turn it back to you, Neil, by saying, where are we with all of this? Like, what is the prognosis? I would say that of the provisions that I spoke to, auto enrollment and the accredited investor provision, the accredited investor provision has a high likelihood of being included if the overall bill gets done. And I think Langston spoke to this well. We think there's a better than 50% chance it gets done. But the auto enrollment provision, I think, is a little bit dicier. It's got issues with it. It scores at, sorry, I don't want to use jargon, but it costs $50 billion over 10 years. And again, we're in an environment where they need every penny to pay for other huge caucus wide priorities. So I'll pause there and turn it back to you, Neil.
Thank you, Bridget. And as you pointed out, the auto enrollment is really Neil's baby. And it was plucked out of the Secure Act, much to the dismay of a lot of the Republicans on the committee. And it doesn't seem to have as strong support in the Senate. So I think whether that one survives is going to be an open question. Okay, let me send it back to Langston and whoever else wants to join in on this. Two big issues, just go over them quickly. Capital gains and carried interest.
Yep. No, thanks. I think I'll start with capital gains. I mean, as King and Bridget spoke to, in the House of Representatives Tax Writing Committee, there was a markup that included, or a draft bill that does include a change to the rate for capital gains. So this bill would increase the capital gains rate to 25%. Now, doing that over, again, since not to get into too much jargon, but going back to what King and Bridget alluded to, the reason for these tax increases is to raise money in order to pay for some of the spending measures. That increase in capital gains to 25% over a course of 10 years would raise about 124 billion. So it's a larger number that is very much appreciated by the broader Democratic caucus. And just to take a step back, when I say broader Democratic caucus, as you may see in the press, there's always a push and pull and tug of war between the progressives and the moderates within the Democratic caucus. And a lot of what will pan out eventually will be a compromise of sorts between those two factions. So the reason I think that's important is because as it relates to capital gains, increase in order to fund some of the spending measures, there tends to be a broad agreement to some degree, and broad in a very general sense, but a broader agreement among the two factions that this is a politically palatable increase that could stay in the bill as it makes its way through the legislative process and ultimately to the president's desk. So there are some members and some important members, including the Senator Manchin from West Virginia that you all may hear about quite a bit in the press, who has made mention about wanting to see the cap gains rate increase up to around 28%. Again, I don't, it's too early to determine, but I sense that there is not as much as support around that particular increase versus the 25%. And so the likelihood that we have that as staying in, if you will, is very likely. As a firm, we believe that there's just a overwhelming support. And again, that's in the most general sense, in a very liberal way, amongst the Democratic caucus. So we think that that will likely stay in. As it relates to carried interest, it's slightly different. There is, although carried interest is a capital gain as the way it's treated, it is a segment of the capital gains that progressive Democrats in particular are attribute to uber wealthy fund managers and want to do everything they can to get rid of it. So this has been an ongoing debate over the past decade, and to recharacterize carried interest as ordinary income from capital gains. What we see now is in that same House Tax Writing Committee, in their legislative proposal, they did not recharacterize carried interest as ordinary income. What they did do was extend the capital gains holding period from 3 years to 5 years. So as King mentioned earlier, the Trump tax package, the TCJA, increased the capital gains holding period from 1 year to 3 years. This bill would increase the holding period from 3 to 5. It does a little more with the holding period that is made it more contentious among the moderates versus progressives, as well as the community of individuals that will be harmed. The fund managers and the real estate and the venture capital funds that use and apply carried interest, and some of you that are on Zoom listening in. The way it works in the holding period is, to give an example, the fund, if Langston's fund invests in company A in 2022, in company B in 2023, and company C in 2024, the clock on the way the language is written, the clock on the holding period does not start until the last acquisition within the fund is made. So if my last acquisition is made in 2024, then that's when the clock starts on the 5-year holding period for purposes of acquiring capital gains treatment on any investment made within the fund. So what does that mean? That means that the acquisition of a company or asset, a capital asset that was made in 2022 would ultimately have a 7-year holding period. And the one made in 2023 would have a 6-year holding period. So why is that important? Because that's a simple, it's a simple example, but from a large extent, a lot of the way funds sometimes don't operate in that manner. And sometimes you have companies that are in a fund for 3 or 4 years before the fund closes. So the fact that the holding period doesn't kick off, if you will, trigger until there is a closure of the fund or the last investment in the fund, has really triggered a lot of consternation among the community of individual funds, managers, and groups that will be impacted. Primarily, those that would say it disallows the individual fund managers as well as the companies themselves to strike at a time when the companies themselves may feel like it's best for them. Their growth is strong and valuations are strong. And the major beneficiaries that I would note of these fund managers, are institutional investors, a lot of your public pensions and the like, that have invested in these funds, and they have also acknowledged that this is an issue. So where are things right now as it relates to this? We are still of the mindset that it's probably around 60 to 80% chance of it happening in some way, shape, or form. I say that because, and it's important to underscore, in some way, shape, or form, there will likely be some changes to the way the rule is written. There have been communications and discussions with the committee, the tax writing committees, about the holding period. And I think there are some senators in particular, some very vocal senators that have made a point to state that carried interest in any way, shape, or form is not something they want to see in this broader reconciliation package. So again, while that may not be the case, while there may be something in the package as it relates to carried interest, it's still unclear at this point, but we have it as a probability of likely. But the question that's ultimately somewhat clear as mud is how it will actually look at the end of the day. So there's a lot of communication, and I would say more on a positive end from the community of individual fund managers and the like that would be impacted, but it's too early to tell whether what the final language will look like. Neil, I'll stop there.
Okay, thank you, Langston.
Neil, if I may, just one other point, because we're talking about the delta between cap gains rate and our projection that it's likely to stick somewhere around the 25% rate going up from the current long-term 20. I would also say relative to where we expect ordinary rates to go, which is to revert back, which is in the Neil draft, ordinary income rates back to 39.6, the pre-TCJA rate, which of course, those rates were under current law are set to expire in 4 years pursuant to that bill because they had to sunset those tax decreases. But just wanted to know that that's the expectation as you're sort of gaming out impacts of a higher capital gain rate, what it's going to be juxtaposed with the OI rate.
Okay, thank you, King. Thank you, Langston. Doug, I'm going to throw one your way, and it also relates to capital gains, which is what's going on with ETFs? It seems that there is some rather significant change to the tax treatment of redemptions in the works. What's going on there?
Yeah, potentially, Neil. So, last month, Senate Finance Committee chair. So the Senate Finance Committee, for those unfamiliar, is the tax writing committee on the Senate side. The committee chairman, Wyden, issued a proposal to modify the tax treatment of pass-through entities, mainly partnerships. One of the more notable provisions within the plan is the removal of the current tax exemption on in-kind redemptions, which I'm sure many of you here are familiar, but with the construction of ETFs, it's the primary means that broker-dealers redeem shares if there aren't enough buyers in the market. So currently, if ETF shares are exchanged for an equivalent basket of securities from within the fund, there's technically no capital gain, therefore no taxable liability that would pass through to the fund shareholders. Unlike, say, with a mutual fund where shares are redeemed for cash that's generated from selling funds within the portfolio, and those capital gains are distributed among all shareholders, typically on a yearly basis. And so essentially this change would put the tax treatment of mutual funds and ETFs on equal footing. Chairman Wyden, for his part, he's described the exemption on in-kind redemptions as a loophole for wealthy investors that was never intended by Congress. He's argued that the vast majority of ETFs are held by the top 5% in terms of household income. Not surprisingly, industry trades, they've pushed back hard on those assertions, most notably the Investment Company Institute, which interestingly enough represents both the mutual fund and ETF industry, has been lobbying and educating lawmakers on the impact of this change and particularly the impact it could have on households making less than $400,000, which would undermine a key promise by President Biden and Democratic leadership.
And I should add, we've made some noise about this issue too. This is an awfully big issue for an awful lot of our members.
And so I think, for people listening, and it is important to remember this proposal was not included in the House Ways and Means proposal. And from our understanding, it's not necessarily considered at the top of the list of tax priorities in ongoing negotiations. And on top of that, there's been some Democratic staff level outreach expressing concern to relevant tax committees. So it does face an uphill climb to make it into the final budget reconciliation deal, especially with the significant pushback that it's receiving from industry. So at this point, we would say it's unlikely to make it in, but on the other hand, it could potentially raise a significant amount of revenue, something like 200 billion over a 10-year period, although it hasn't officially been scored by the Joint Committee on Taxation, which is the official entity that does the scoring of tax.
The JCT that I mentioned earlier.
Exactly. So, with a number like that, 200 billion, you can't take it off the table completely. But again, we still say that we would still consider it very unlikely at this point.
And I might add, even if this bill gets pared down to 2 trillion or less, as appears likely, so they don't need the same need for all these pay-fors, all these tax increases, it's likely they could drop a lot of these provisions, but new ones that are not in the House bill, like this ETF issue, could appear as a result of work done in the Senate. So we can't take too much comfort on this, but certainly appreciate it and feeling optimistic based on your assessment. Let me just take this moment to talk about 2 things that IAA and its members have been working on, and you all listening on this webinar, I hope you've written Congress about it using our Take Action Now feature of our website. 2 tax issues. One has to do with the deductibility of advisory fees. We tried to get a provision in one of the COVID relief bills. We did not succeed. It is not in this package, and it would cost money, so it would need a pay for. We're going to continue to work this issue. There was a provision that allowed for limited deductibility of advisory fees before the 2017 Tax Cuts Act. That provision expires in 2025. So sooner or later, Congress is going to have to deal with this issue. We're going to be there, and we're going to need all our members weighing in. Second issue, pass-throughs. As you know, there was a very generous pass-through deduction, 20% deduction created to sort of more equalize tax rates with the lowered corporate rates in 2017. Advisors and most service businesses were excluded. They were subject to a very low limit. Wyden does have a bill, the Small Business Tax Fairness Act, that would completely redo the pass-throughs and raise loads of money. It would restrict the only owners of pass-through businesses whose income was less than 400 grand would be able to take advantage of the provision. However, it does get rid of all the exclusions. So advisors and other services businesses would be able to take advantage of it. I guess that's good, but with the 400 grand limit, perhaps not as good as we had hoped. We've written Wyden about it, but again, it's not in the reconciliation bill, and I don't think it's going to make it in there. Okay, we've gotten a bunch of questions that have come in the chat. I am going to try to direct them to the person on this panel who knows a bit about them. Mega Roth sounds scary. I don't know what it is. Chris, what's going on with the Mega Roth?
Well, don't be scared unless you have a Mega Roth. Look, the House legislation includes new stipulations for individuals with retirement savings of over $10 million. And that's a combination of both IRA savings and money in defined contribution plans. That the legislation would cap that at 10 mil, would require minimum distributions on an annual basis. It would also repeal any Roth conversion for individual retirement accounts for individuals making over that $400,000 figure again. You know, this really, Neil, was born of a ProPublica article that reported that Peter Thiel, a co-founder of PayPal, has an IRA that is worth $5 billion, and that was a 2019 figure according to the article. And frankly, that narrative just does not jive with congressional Democrats, right? There is a broad recognition among congressional Democrats that these mega Roths are really just a tax loophole. And so this legislation has the potential to close that loophole to a degree. I think there's the provision only raises, since we're talking about raising cash here for the government, it only raises 1.8 billion. That's the estimate, but it's the political sentiment that's really important here. And the provision has support, not just from progressives, but from moderate Democrats as well. So even though it's not a huge revenue raiser for the government, I think there's a very good chance that limitations on mega Roth are included in the final package.
Thank you, Chris. Another question has to do with stepped up basis, another very scary concept. King, I'm not aware of any stepped up basis provisions in the bill, although of course it gets talked about a whole bunch. What is your read on that?
Well, it gets talked about because the president and the administration put a proposal to make changes to stepped up basis. The current law treatment that you can reset your cost basis at death and an investment would do away with that. That was in what we call the Green Book, which is the revenue proposals from the administration, from the Treasury Department. It was actively debated amongst House Democrats, and I think there was a bicameral conversation. When I say bicameral, I mean between the House of Representatives and the Senate, about whether or not to include that. There was a lot of what we call in DC noise made by family farms and the like business owners that would be in a liquidity, would have a liquidity event if that change were to be made. And so ultimately it was not included in the House of Representatives committee draft, the Neil Mark. I would just say that the president, after the Neil Mark, made some comments that he still supported doing something on stepped up basis. The Senate, as we've been discussing, is certainly going to put their blueprint in some way, shape, or form on this bill, as we were discussing with Doug's policy earlier, some widened proposals that are out in the ether. They may not be going through regular order. I would say this is one to watch. It is very much tied to the potential change to the rate on cap gains revenue or capital gains rate, the revenue derived, because of course you have behavioral changes, right? If you know that there's going to be a basis reset, you might be more or less likely, if there's a capital gain rate change, to go ahead and sell an asset, versus if there's just a capital gain rate increase and no stepped up basis, you know, the revenue estimators believe that you might hold on to the asset until there's, you know, a change to reduce that rate. So there's a lot of interplay in the amount of revenue that's raised for the US government between those provisions. We don't think it's likely standing here today, but there are a lot of open issues, and this again is another one to watch and be aware of. It is far from just being definitively out of consideration, I should say, Neil.
Thank you, King. Okay, I have 3 questions that have come through. We have about 6 minutes, and I want to leave at least 5 minutes to thank you guys. So let's see if we can hit these quickly. Grantors Trusts, a popular estate planning benefit. Doug, are they on the chopping block?
Very much so. I mean, so for those unfamiliar, grantor trust is it's a trust in which the individual who creates the trust is the owner of the assets and property for income tax purposes. And like you said, it's a popular estate planning tool used mostly by high net worth individuals because assets held within the trust are not included in the grantor's estate and therefore not currently subject to estate tax upon the grantor's death. But in the House Ways and Means proposal that we've been talking about, it includes a provision that would eliminate that exemption, and assets owned by the grantor trust would be included in the grantor's estate for tax purposes. As you could probably guess, because of the limited number of individuals that would be scoped in, it doesn't raise a lot of revenue, about 7.8 billion over 10 years. So, if the proposal were to get cut, it wouldn't have a huge impact on the ability to pay for the bill, but we still think, it has a pretty good chance of staying in, probably more than a good chance of staying in. We know there's been some limited industry pushback, particularly in the life insurance space, but we haven't picked up too much in terms of pushback from lawmakers themselves. And this is, this also plays into a lot of what we've been talking about earlier in terms of the broader conversation around dynastic wealth. And so the justification for pulling it out of the bill at this stage would have to be particularly compelling, in the face of what would likely be some pretty heavy pushback from progressives.
Thank you. Okay, we got a couple more questions. I'm determined to try to get through as many of them as I can. And perhaps, King, you can deal with this one. Mark-to-market derivatives, there seem to be some, maybe some.
Yeah, it's a maybe. Again, this is another Chairman Wyden, the chairman of the Senate Tax Writing Committee, has essentially been floating proposals all spring, summer, and into the fall in various areas of the tax code. That was by design, talking to the leadership in the Senate, knowing that they were unlikely to go through regular order, knowing that there may be resistance to certain tax increase proposals over in the House, and knowing that ultimately they have to come up with something to pay for the spending, that the thought was, let's put out as many different proposals out there to have things to grab. So this mark-to-market, the bill is called Modernization of Derivatives Tax Act, but mark-to-market for derivatives, ordinary treatment, it's a razor of the order of meaning how much revenue would be derived of about 15 or 16 billion dollars. It is a little bit different from what Doug was describing about policies that really focus on income inequality and the delta between ordinary income and wealth. This is highly technical. This is very much trading, hedging, would need lots of exceptions, special rules, complicated. It would need an enormous amount of regs that Treasury would write. For a variety of reasons, it hasn't gone through enough of the process. I put this in a pretty unlikely likelihood standing where we are today. But it is out there. We may hear more about it as we go through the next month or two.
Okay, I had one question about whether there are any collective efforts to get rid of the language that we discussed on auto IRAs. Yes, please go to our website under advocacy. It will link you to that issue and a template letter that you can customize that can go to Congress. Please do it. Then we have another question here. What are the chances that the capital gains tax increase would be retroactive? If so, what retroactive date is likely? Who wants that one?
Well, why don't I take that, Langston? I sort of alluded to that earlier. So currently, the House Ways and Means draft, the increase from 20 to 25% on long-term capital gains rate, has an effective date of the date of introduction of that package, which was September, keep me honest here, Doug, either the 12th or the 13th.
13th.
13th. So you say, well, we're into October, the bill hasn't passed. That would effectively, if the bill was passed tomorrow, be a retroactive increase. That is fairly common to go ahead and date back on a date of introduction prior to that bill being introduced, Neil, when the administration rolled out their green book and their proposals. At that time, the effective date was believed to be the date of introduction of the White House administration's proposal. That date could change. And I will just say that I don't expect that item to be finalized whether it's date of enactment or backdated to that September 13th until the very end of the process. That will be one of the last things they decide.
Okay, well, we have come to 4:30. It's been a dense 45 minutes. I appreciate everybody who called in about this. Please stay in touch. Take a look at the emails and the member alerts and what's on our website. If we're going to have an impact on these issues, we need you to help us to weigh in. I would like to thank this wonderful team that we work with from Mindset, and thank you to Langston Emerson, King Mueller, Bridget Hagan, Chris Brown, and Doug Lee. And I hope everybody has a productive afternoon and a good evening. Thank you for calling in.